Good morning, everyone. So today we will cover the last topic of this chapter 16, which is the stock option, compensatory stock option. And so continue with the approach we have taken. So we'll start by looking at an example and introduce the issues and accounting. And by then we will finish all the topics. So you should be able to attack your assignment. And we will use the remaining time to go over each one of the topics with a more comprehensive example and get a little bit deeper in each topic. So we start with looking at this example. It's very simple. It's all in the course, the chapter slide I posted. So therefore, like, if have you prepared in the slides, you'll be prepared for this discussion. Okay. So let's make it a little bit bigger. Okay. So this is the example. This is the example in the slides. It says on January 1st, 2021, options to purchase 2,000 of the company's shares at an exercise price of $60 were granted to the company's executives. The options are exercisable after 2 years on December 31st, 2022. The fair value of the option on January 1st, 2021 was $220,000. 20% of the options were exercised on June 1st, 2024. The remaining options were not exercised until expiration date. So that's the option. So stock option used as compensation has become very, very popular. So Wall Street Journal publishes, the highest paid CEO in America, like on an annual basis. So if you look at those lists, the salaries, the tax law in the US is that any compensation over $1 million will be taxed very heavily. However, performance-based compensation is not subject to the same tax rules, right? So that I think each one of the 100 highly paid CEOs will earn over hundreds of millions of dollars. And so only $1 million of their total compensation is cash compensation. And the rest will be stock options. So like this is significant in terms of the magnitude, right? The dollar amount we're talking about. Now, other than the tax rules, the stock option initially was introduced because it's supposed to tie the performance of the executives, the managers, the employees to the performance of the company, and therefore to the interest of the shareholders. That's the idea. So let's look at this example to see how could stock option achieve such a goal. Okay, so the option were granted to executives. Well, the executive make decision that would have significant impact of the company's performance, right? So that's usually it's most of these are 1 to top executives. The employees gets a little bit, but that's not that much. Okay, so they were given to the executives, and what were they given? They were given the options to purchase shares at a predetermined price called the strike price, $6 per share. And so this is a key sentence. The options are excisable. I think that's the excisable. After 2 years. Okay, so options were granted on January 1st, so you can't exercise them until after December 31st, 2022. Okay, now we know option now, like, so just like, what do we know about the option? It's a complex financial instrument. It's a derivative. It's derived from an underlying instrument. In this case, it's the shares of the company. The value of the option depends on the value of the underlying company's common stock, right? So if the company, if the company's stock price is below 60, the options have no value, right? You can buy shares and it's cheaper without using the option. So option will be out of money. We know that, right? Option will be out of the money. The higher the price of the stock, the higher the value of the option, right? That's the dependence relationship. So it will be beneficial to the executives if the company's stock price goes up, is high. And so the idea is there are 2-year period, the executives through their performance could enhance the value of the stock. And by doing so, they will benefit. The higher the underlying stock price, the more valuable these options will become, right? So here, the interest of the executives and the interest of the company's shareholders are aligned. Like if I work for my best interest, it will be for shareholders' best interest as well. So that's how it's supposed to work. And so this is why it's designed. So after December 31st, 2020, usually there's a period executives can exercise the options, and then like at some point it will expire. So that's how it works, right? So we discussion about stock option ties in here. So we know why some people believe this compensation schemes will be better than just paying salaries, and this will align the interest of the company and the shareholders with interest of the executives. So like it will motivate them to work really hard for the company, and harder they work, the better off they are, and harder they work, the better off the shareholders are. So that's the idea, right? So let's introduce some of just some of the terms. Okay, so how does it work? And again, I want to repeat this, like accounting, we're telling the story. And so we need to get our story straight before we can tell it properly, right? So what's going on here? So usually what happens is it would be the board would meet and they would discuss like a compensation for the executives. And they will have to approve any like stock option plans, like mind you, if you read the textbook, there are many share-based compensation schemes. And there are many others, and like we focus on compensatory stock option plan, just this one. First of all, because this is very commonly used, and it involves has economic significance because it like involves lots of money, and the principle between these and the others are similar. So one way or another, you kind of tie your compensation to the stock performance one way or the other, right? So like that way, that what's good for you would be what's good for the company, and so on and so forth. We just focus on this one, and then once we get this one done, the others are not that hard. There's lots of similarities. So okay, so first there is the plan has to be approved by the board. And then that's nothing needed to be done, because that's basically, you have a plan, you make a decision, nothing has been done yet. So there's a date of approval actually before anything like that, right? And then after that, there will be a grant date. So that date, the options will be granted to the executives. And this is the idea that hopefully by giving these options, you will do certain things. So there are certain conditions. Like first of all, you can't take option and leave. Most of the cases you have to actually work. So there is a period you have to work before these options actually, vested. That's the word, vesting date. I think that's vesting date. So by then, you have ideas, you have met the requirement of earning these options. So even if you leave, you can still keep these options, right? So that's a vesting date. And then usually only after the vesting date, you could exercise them. Okay, well, there's a period you can exercise, right? So so the exercise date date. So this, like, there's not one particular date. It would be between vesting date and expiration date. So there's somewhere, and then there's the expiration date. So after that, you can't use it anymore. Okay, so those are the dates. Okay, now, so that's what's going on. So like the board has to approve the plan first, and then they decide like when to actually grant it, the date, and there is a period of time if after granting date, before the vesting date, if an executive leaves its employment or have committed some wrongdoings, they can forfeit that. Okay, so like you have to earn the keys. You have to comply certain conditions in order to keep these options. Okay, so sometimes certain options can be forfeited before they vest, and then it will be canceled. And only after vesting date and before expiration date, you can exercise. Okay, so from an accounting perspective, now we're accounting class, we're accountants, we need to know how do we record them, how do we report them, how do we recognize them, how do we measure them? That's the our task. That's the problem we try to solve, right? So now, given this is a stock option, so naturally the first thing we go, there is a cost to the company to give these things to the executives. So compensation expense should be recognized. That would be natural, right? That was actually hugely controversial. Now we were like, of course. That's hugely controversial during the dot-com booms, like bubbles that time. So what happened was, the options, we have come a long way to assign a value, to measure derivatives, because they're like, hard to measure, right? And so for the longest time that a company will be giving out these options, and there was no particular accounting standard to say how should you measure these options. And now some companies use only the intrinsic value, but lots of derivatives has no intrinsic value, especially early on. The only value they have would be the time value. And the time value, now that is, you know, the model that's used to measure stock options were like the originally come up by two physicists. And they were the model to predict the movement of particles. And it was like very scientific, like, you know, it's a kind of a revolutionary to introduce them into accounting, use it to measure financial instrument, right? So that was not, you know, like not accepted in accounting for a long time. I was remember the time this would be a big news, like Bitcoin kind of a news, I think the US started looking into this issue. The issue is you have these executives from .com company, they will earn like hundreds of $1 million, yeah? And you look at the company's financial state, there's no compensation expense at all. You know, like huge wealth are earned by these executives at whose cost? Obviously, they cost somebody something that's not recognized anywhere at all. And I think the accounting standard board come up with the recommendation, which is the one that currently accepted by IFRS and everything. But at that time was kind of ahead of its time. And especially like the senators from California, Silicon Valley is there. And so they opposed it very strongly. So for political reasons, it was defeated. They actually threatened the accounting standard boards. You better come up with some better standards that do the job. So they backed down. They said, well, we still think these are the proper thing to do, but we strongly recommend you to do that. You're not required to do it. So that was like about 2000, you know, at that time. Oh, it's actually before 2000 because I was still in school. And then the world fell apart, the world in the Silicon, you know, the .com bubble bursted, and then they revisited it again. And so now finally, here we are. So we have to measure whatever the value of the option granted to the executives, that should be the compensation expense, right? And so, so the current standard is on the grant date. On the grant date, the options should be measured, and that should be both the intrinsic value and the time value. Okay, so this is the value given. So the value 220,000, that is come up with this using the things like a Black-Scholes model, okay, something like that, quite fancy. We will never, you don't need to do that in this class, but that's how they come up with the number, okay, and that is the total compensation, okay, and for what period this compensation should be recognized? Well, it should be the period executive have to earn them. Makes sense, right? So this total number should be recognized between the grant date and the vesting date. That makes perfect sense, right? Like grant date and like here, it's granted on January 1st, 2021, and it is vested. It will be vested on December 31st, 2022. It's a 2-year vesting period. So this 220,000 will be allocated to that 2 years. Okay. And then when it's exercised, we have to record that. Now, the exercise is recorded using the book value method. Okay. So what does that mean? Let's just look at this example. So I will just use this, and I will just use this to record that. So on January 1st, that's the grant date. So, right, what do we do? Now we know there's the expense to be recognized, but the expense should be recognized when incurred, right? And the options will be earned during the 2-year period. So this is the beginning of that period. So we don't need to recognize expense yet, right? Just like when a company pays insurance expense for like a 2-year policy, when you pay, you do not recognize expense yet. Okay, so in this case, you don't even need to recognize anything. You don't even need to recognize prepaid. Okay, so no journal entries. No journal entries. These options are not vested yet. Okay, and that hasn't been earned yet, so expense hasn't incurred for the company. On December 31st, so like I better put a year in, 2021. On December 31st, 2021. So now 1 year vesting period is complete. Presumably the employees or like the executives are all there, so they earned 1 year, half of that, right? So the journal entry would include a debit to compensation expense or any like compensation expense will do. So that would be half of that, right? No, 110,000. Now, what's the stock option price now? We don't know. Well, in all likelihood, if there is a market, the stock option value may have changed depending on what happened in that year, right? It's possible. We don't know, we don't care. Doesn't matter. The stock option was granted on the grant date, and that's the value on that date matter. Okay, we don't like sometimes though in the problem, they kind of they kind of make things easier. They only give you the information you need. Sometimes a problem gives you all kind of information, and lots of them you don't need. And so it's just as important as knowing what to use, what not to use is also important. Okay, so we will credit stock option. So what is the stock option here? What kind of item is it?
Equity.
It's equity, right? It's not a liability, it's a contributed surplus. Stock option, $110,000. And then, so that's like, we'll repeat the same thing for December 31st, 2022. Makes sense, right? Another year, another entry to record the second year of the stock. So by then, stock options are vested. Okay. So like in theory, they can exercise right away if they want. So what happened after this vesting date does not reflect on this anymore. Okay. Okay, then June 1st, 2024. Okay, so these are not entry. I'm just copy paste to make it easy. So don't write these yet. Okay. So now on June 1st, 2024, 20% of the options were exercised. Okay. Now, sometimes, like I think if many other examples in textbook, they will tell you, oh, what's the stock price now? Maybe even what's the option price is now. We don't care. Book value. Book value means we focus on book value. So what happened here is, first of all, when the stock are exercised, the executive paid what's the $60 to purchase each share, right? So the total, the options allow the executives to purchase 2,000 shares in total. So 20% of that would be 4,000 shares. So like, let's do the calculation. So that's 2,000 shares. That's how much they will, they're allowed to purchase altogether. So now 20% of that were exercised. Is that how it goes? 20% of options were exercised. And then each options would allow the executive to pay $60 for each shares. So the total amount the executive would have to pay would be 24,000. Yes, 24,000. Okay, will be 24,000. 20%, $60. 24,000. Okay. Somehow this number looks awfully small to me. Okay. So we'll debit cash $24,000. And also, that means 20% of the options will be removed, because 20% of the options will be no longer there, right? So we have to remove 20% of the option from our balance sheet. This is where book value comes in, right? So also debit contributed surplus stock options, I'll just say options to save space. So 20% of the total $220,000 is $44,000, right? Right, so that's it. I will do the calculation here. So the options 220,000, that's the value. And at 20% of that, that's 44,000. $44,000 worth of options were exercised. So we remove that from our financial statement, from the account. And the book value says that whatever you removed there will become the value you put in the common shares. So in this case, it would be $68,000. Okay. The fair value of the shares may not be $68,000, but doesn't matter. We're not using fair value. We are using book value. Okay, so it's book value method. It's book value. And the one more thing we need to do is There's no data on that, but we know the remaining stock options are expired. And we have to record that. If they're expired, no longer exist, so we have to remove those from the balance sheet, from the accounts. We have to reflect that. And so the remaining will be 200, 44, 220,000 minus 44,000. So what do we have? We have 176,000. Yes. Thank you. So that's, yeah. So to remove that, we will debit contributed stock option 176,000. Debit. And what the way we credited it is called another shareholders equity account called contributed surplus expired options 176 expired. They will not be exercised. Okay. To sum it up, is that the options for accounting purpose, for the issuer's purpose, are valued on grant date. And that's the date we determine the value of the options, and then that value would be the total compensation expense. And that total amount is recognized during the vesting period. That's between the grant date and the vesting date. Okay. And when the options are exercised after the vesting, we use book value method to record it. Okay, we use the book value method to record it. It's spread out so much. Yeah. And if they're expired, we remove them out of the contributed surplus stock options and transfer the value to contributed surplus expired options. Okay, so that's pretty much. There is a little bit of a situation we need to deal with, like, for instance, what happens if stock options are forfeited. If stock options are forfeited, that we just reverse it. Yeah, because they are not vested yet. That can only happen, and we just reverse it and remove it from the account. Okay, so the important date is the grant date is normally the measurement date. That's really important. Nothing needs to be recorded on the date, but we need to measure the options. And between the grant date and the vesting date, that's called the vesting period. And it's also sometimes called called the service period. So it means through the service of the receivers of the option that rendered during this period, they earned the option. And they earned the option, and therefore the expense related to the compensation will be recognized during this period. So that's after vesting period before the expiry date, that's the period options can be exercised. Now, the options or exercise depends, right? After the expiration date, any unexercised option will be considered expired and it needs to be removed. One question, why do you think the people would let it expire if it's not in the money, right? It does not have to be like it never be in the money during that period, because say, if you expect the price continue to rise, so you want to wait until it goes higher, but it's one or the other direction. So you could run out of time before it get to be back in the money again. Does that make sense? Yeah, it's a kind of a tricky thing. I actually have a personal friend who had a very sad story because somehow he just missed that. He told his broker that he would exercise them if the stock price reached such a price, and it went very close, but it didn't go high enough, and so he never did exercise them. But by receiving option, he's considered compensated, so he had to pay tax on those options he received, and he never did it, and yeah, was not very happy ending about that. So it's kind of okay, so let's look at an example, has a little bit more into it. I'm not going to go over the slides again because they have lots of other things, and to make this topic really kind of complicated, and all we need to know for this course purpose is the compensatory stock options. So I would like just to go over another example to drive in home some of the concepts. Okay, so that's okay. So these are is that next that I posted, but I realized that I posted these additional example in the folder that only I can see. So I will transfer them to the folder you can see later on. But let's look at this. Good. Is that big enough to see it? Okay. So this is the example. Prepare all necessary entries from December 1st, 2016 to October 31st, 2020 for the following event. If no entry is needed, write no entry necessary. So on December 1st, 2016, the shareholders of Jubilee Inc. adopted a stock option plan for its 5 top executives, where each could receive rights to purchase up to 3,000 common shares at $40 per share. At this date, the share were trading for $32 per share. So this is not even grant date. This is even before the grant date, it's approval date, right? And then there's a little bit extra information, so kind of to emphasize the fact that stock option is not in the money now, but doesn't mean it has no value, right? There's no intrinsic value, but there should be value. Otherwise, people, why do you want something has no value, right? So yeah, there very likely will be time value. On January 2nd, 2017, options were granted to 5 executives to purchase 3,000 shares each. The options were non-transferable, and the executive had to remain an employee of the company to exercise the option. The options expires on October 31st, 2020. It is assumed that options were for service performed equally in 2017 through 2019. The Black-Scholes option pricing model determined the total compensation expense to be $390,000, because it was a little bit more details here. So this is a condition. The employee, the executive, has to remain employed by the company to exercise the option. So that means even after the vaccine date, right? They cannot, they have to still be employed to exercise. If they leave the company, they cannot exercise that. Also, this Black-Scholes option pricing model give this value of 390,000. That is the fair value estimated of the stock option on January 2nd. And that would be the total compensation expense. And this total compensation expense will be recognized during this period that the service will be performed. That's 3 years, 17, 18, 19. Okay, so that's it. Do we need to record anything? We don't need to record anything yet, right? So the first thing that needs to be recorded will be when the options are when the earned by the executives. Okay, at this point, it's at the very beginning of this plan, and no service has been rendered, so no option has been earned. Okay, but what we would have to do is to recognize the value of option gradually over a 3-year period. So on December 31st, 2017, we need to recognize 1/3 of that value. On December 31st, 2018, 2019, so that 3 dates, 1/3 each. On February 1st, 2020, while Jubilee's share were trading at $55 per share, 3 executives exercised their options. And on September 3rd, 2020, while Jubilee shares were trading at $44 per share, the 4th executive exercised her option. And then on October 31st, the remaining options expired. So that's okay. Okay. So, so that's answer these questions. Or just do the journal entry altogether. Okay. So on the first date we have here is December 31st. December 31st, 2016. That's the approval date. No entry are necessary. Okay. And next date is January 1st, I believe. January 2nd, 2017. That's the grant date. No entries are necessary. Okay. Now the next 3 dates, they have the same entries. So I will list them together here. December 31st, 2017, 2018, and 2019, they're the same adjusting entry, right? So we'll record compensation expense, so it will be $130,000 each time, and the contributed surplus stock option, that'll be 130. So by then you will recognize the entire $330,000 over a 3-year period. So the next date would it be February 1st, 2020. I don't know why my font changed.
Bring your business online. Start selling with Shopify, the e-commerce platform that's trusted by over 1 million businesses worldwide.
Somebody's. Oh, they're all muted. So who is it not muted? I get muted. Okay. Well, never mind the font. I'll worry about font later. February 1st, 2020. Three executives exercise their options. Okay, so each executive can purchase. So each executive can purchase 3,000 shares. Those three executives, that's 9,000 shares, and at a $40 per share. So that's $360. So this will be calculated as 3,000 shares each. Three executives use all their stock option, and for each shares they purchase, they pay $40,000. $40, sorry, $40. Okay, and now, the options that needs to be removed, sorry. Contributed surplus. Options. To be removed, should it be now? I calculated here our $234,000. Okay, so this is $390 divided by 5 executives, and then that's give you the value of the option each executive receives and times 3. So that's how to get that. And all that goes into common shares. So that's $594,000. Okay, so that's the entry on February 1st. And then on September 1st, oh, just September 3rd, sorry. On September 3rd, well, the share is $44 per share. The 4th executive exercised her option. So same entry. Now I'm just going to change the number a little bit. So now because it's only one executive, so the cash would be $120,000, that's only for 3,000 shares. And the stock option to be removed is 78,000. And the total common share would be valued, that's at 198. Okay. On the what value? 390? That's given. Yeah, that's the outcome of the Black-Scholes model. Okay, as I mentioned, applying a Black-Scholes model is not what we were in this class, so this number will always be given. Okay. Now, what is interesting here is now on February 1st, the stock price is $55 per share. On September 3rd, the stock price is $44 per share. However, if you compute the value of your stock, you recorded here, this is 198, which is for 3,000 shares. Okay, so what you recorded here, you know, let's say, try this. $198,000 divided by 3,000. So we have $66 per share, right? Okay, so when we record the exercise of the stock option, we give $66 to each share we recognize as issued. But if you look at the February 1st, on that date, so I know there's a question, I will get to that in 1 minute. So we have total amount recognized is 594,000, and that's for how many shares? 9,000 shares. Okay, and then so that you calculated is $60 per share. Okay. Now, on February 1st, the actual market price of the share is $55. And on September 3rd, the actual market share is $44. However, for both dates, we recognize the $66 per share in our journal entry because we use book value method. Right? Does that make sense? Yes. The estimate is a bit off. Whatever the option value that has at the time the option was granted, the stock price did not live up to that potential. Okay. However, that was the estimate. That's how much we recognized as compensation expense, and that reflected here. Okay. So we do not go back to make adjustment. We just keep going with that assumption. And so reflected here. When we recognize common shares issued, we use the book value instead of the market value. Okay, so that's, as I said, that was one of the things that get people confused, because in the previous example, you're not likely to make any mistake because you don't know, you were not given the share price at the time of exercise. Okay. However, when it's given, it's so tempting to say, you know, if we issue shares, shouldn't we record how much it's worth now? But not in this case. It's an exercise of stock options, right? And then on October 31st, remaining options expired. Oh yeah, there was a question. Sorry, I didn't say that we're going to. Okay, so the question is, why did they have these $40 here? This is given as the exercise price. See, that's the price as part of the terms of the option. When you exercise an option, you pay $40 regardless what the going price is. You can buy the shares using this option for $40 per share. Okay. Yeah. So the last part is the expiration of the remaining. That's October 31st, 2020. Okay. So on that date, the remaining option expired, so I have contributed surplus. Stock option, it's an equity account, so when we debited, we reduce it at 78,000. It's 1/5 of the 390,000. Okay, and we move that, transfer that to contributed surplus, expired options. 78,000. And that will be it. And the last question is, suggest a scenario that fifth executive let his stock option expire. Now, this is more, how do you say it? This is a more, that we have more information to imagine why that might happen, right? So based on our recording here, that there at one time, it was the expectation that the share price will reach to about $66. Okay, but from what we are told, we know at one time it reached $55. And these three executive exercises, I would say they compromised a little bit, right? Because that was not as high as like the Black-Scholes model have expected to be, right? And then instead of getting closer to that target, it actually went the other direction. So when this fourth executive exercise, that he benefited very little. He got some benefit, $4 per share. That's what he got, not much. So if the fifth hold out, this hope for things to improve, that didn't happen. So probably between September 3rd and October 31st, is that October? Yeah, October 1st, it went out of money, so they never had a chance to exercise. So that kind of provide us a scenario that's kind of easy to imagine. Okay, so that's about that. Now, about pretty much all the chapters, all the problems we have to solve. One of the things that's like unique for this, well, I wouldn't say unique, but it's definitely true for this course, is that the question always contains a lot of information. And it's very important to read a question, just like we are trying to tell the story and get that story straight in your head before you try to tell it. So every time, like before the exam, I will give this advice, like take your time to read the question, make sure you understand the question, and during the exam, like, usually the story for you to record and report is quite complex. That's why there is a lot of information. Sometimes if you find it's unclear to you. Now, during the exam, I do not answer questions like, what does that mean? I cannot explain to you what the question means during the exam, right? So again, this is my interpretation. Is that correct? Now, that's the question for you to answer. I'm not going to answer a question like that. But what you can do is you can say, I assume this is what it means. Okay, and then you just, even if your answer is not, if you interpret it wrong, but at least I can tell, like, that's isolated, that's the reason your answer is different from mine. But as long as it follows through, you will get most of the credit. Okay, so just jump ahead that little bit. But okay, okay. Now for the time remaining, I want to start an example, but I may not get to finish it. But this one, you have a similar question in the assignment. Okay, so I'm going back to, now we talk about the three things, or if you wish, it's the four things. We have derivatives, and the derivatives used for hedging. The accounting can be different. We have a compound hybrid financial instrument, and we have compensatory stock options. So that those are 3-4 topics so we talked about there. So I want to show a example about the fair value hedging. And so so let's just if nothing else for me to accomplish today, at least we can read through the question, because you have a question similar to this. Okay, so we can at least read through that, just get the story straight. So this is a fair value hedge. And as we mentioned under IFRS, that one, there is accounting asymmetry. There is a elective accounting method you can use to ensure or restore that accounting symmetry. So that means if you have a hedging situation, the gain or loss from hedged and hedging items should cancel each other out. Okay, that's the fact, that's the reality. However, if when you record a hedged and hedging item in accounting, they do not cancel each other out, then you don't have symmetry. Okay, so for in that situation, you can deviate from the normal accounting for these two items and use hedge accounting. In hedge accounting, there are two different hedges. The accounting for these two different hedges are different. One is called the fair value hedge. One is called the cash flow hedge, right? So since hedging instrument is always derivative, so hedging, normal accounting is fair value through net income. Okay, so if it's a fair value hedge, the very hedging instrument, you stay with the fair value through net income. What you have to do is you may have to change how you count the hedged item to ensure symmetry. If it's a cash flow hedge, you do not count hedging derivatives normally. Instead of fair value through net income, you go fair value through other comprehensive income. Okay, so this is a quick review. So on December 31st, 2017, Robi Corp had 10 million 8% fixed rate bond outstanding. So it means like there's a bond that requires Robi to pay 8% interest on $10 million. The interest of the bond are paid semi-annually on June 30th and December 31st every year. Okay, so means Robi has to pay 4% on 8 million every 6 months. Robi decided to enter into a swap agreement with the accounting bank to convert fixed rate debt to floating rate debt with the settlement date matching the interest payment on the bond. Now, it's kind of like you need to really stretch yourself to say, why would Robi do that? Why would Robi do that? Now, since it's called a fair value hedge, we know what happens to bonds on our balance sheet. The value doesn't change, right? So the fair value of bonds can go up and down with the interest rate, but we don't change it. However, it doesn't mean it's irrelevant for the issuing company. Like it's irrelevant if the issuing company's intention is, well, I'm just going to pay interest, and when it matures, I will pay back the principal. If that's the situation, the issuer does not care. Like if the market rate goes down, he will be happy because oh no, if the market rate goes up, he will be happy, right? Because he has to need more money now, he will have to pay more rate. if the market rate goes down, too bad, because you already entered this contract, this is the rate you're gonna pay, right? But it doesn't have to record that up and down changing value of the bond. However, sometimes the company may want to purchase their debt back on the open market, retire it early, for instance, then the fair value is relevant, right? If the fair value goes up, to retire these bonds, they will have to pay more. So, so for that reason, if the company, for whatever reason, want to retire its bonds before they mature, they would care about the fair value. And then if they don't want to end up to pay a whole lot more than they have to, they can enter into a interest swap. So what happens is, like, if the market rate goes up, then the bond value will go down. They will have gain on that, but then they will have a loss on the interest rate swap. If the market rate goes down, the bond value will go up, but they will have a gain on the swap. So that's why it's fair value. Fair value, you were talking about the items that's already on your balance sheet, right? So anyway, so I guess we interested in how to record this. Now, in case you wonder why would a company do that, you see lots of time company go, well, I have a variable rate bond. The interest can go up and down, and I don't want that uncertainty. I will enter a swap to convert that into fixed rate bond. You know, that will be more intuitively kind of understandable for this one. Okay, the term of the swap specify that Robi will receive interest rate at a fixed rate, interest at a fixed rate of 8%, and it will pay a variable rate equal to 6 months LIBOR rate, okay, based on a 10 million amount. The LIBOR rate on December 31st was 8%, so there is no cost to enter into the swap. That's the LIBOR rate will be reset every 6 months. That will be used to determine the variable rate to be paid for the following 6-month period. Now, what I have here is basically the LIBOR rate that's applicable for that period, for the period and on that date. So that's what I have here. Assume that hedging relationship meets all the conditions necessary for hedge accounting. The 6-month LIBOR rate and the swap and the fair value were as below, right? So in this case, when we enter that, like there's no cost, so we don't have anything. And 6 months later, the market rate, LIBOR rate goes down. What happens when the LIBOR rate goes down to the fair value of the debt? Considering the debt value is the present value of future cash payment. So if the interest rate goes down, the bond value goes. If the interest rate goes down, the bond value goes. If the interest rate goes down, you discount less, right? So the future interest and the future, what do you call it? Fair value, the face amount doesn't change, right? So the future cash flow doesn't change. If the discount rate is low, then the present value is high, right? So it discounts less. If the discount rate is, the interest rate is high, that means you discount more, so the present value will be less. Okay, so in this case, on June 18th, the market rate went down. Okay, so the swap is valuable because the Robi now will pay a 7.5%, but it will receive 8%, right? So the swap would have a positive value. So if you want to recognize its derivative, it will be an asset, okay? However, because the interest rate went down, so now the fair value of the debt will go up. For a company, when the debt value go up, it's a loss, right? If now you owe more if you pay at market rate. Does that make sense? Yeah. However, because of this swap, this loss is offset by this gain. Its loss is offset by this gain. Does that make sense? Yeah. And the next time the interest rate, now it's higher, 9%. So this fair value, the swap now it has a advantage to the counterpart because Robi will be paying 9% on 10 millions and receiving 8%. That's not a good deal, right? So what happened here is that swap changed from a asset to a liability. And the change from 200,000 asset to 460,000 liability, that's a loss of $660,000. And then, so the loss on the swap will be offset by the gain on the debt. So that's what it says. Okay, now, does that make sense? And what this information means? Yeah, okay. Now, last thing I want to say is since it's a fair value hedge, right? So what that means is, well, you have to record a derivative, use fair value, so net income. That's the fair value accounting says, right? Sorry. That's the hedging accounting says. For fair value hedges, the hedging item, you use fair value, so net income. So you would recognize these gain or losses in your income statement. Now, the bond, normally, we do not recognize change in fair value. Remember, normally the notes payable, the bonds payable, once we recognize when it's issued, we may adjust for like a discount or premium, but it's all book value method, right? That's based on at the time of the issuance, how much you recorded. You want to gradually move it to this face amount. If you issued at par, you do nothing, regardless of what's going on in the market. If it's issued at a discount, you amortize the discount. So the discount will be fully amortized when it matures. It will be just a fair value, a face value left. And if there are premiums, otherwise. So that's normally. So normal accounting for bonds would tell us not to record gain or loss on bond. But now it's not normal. We're using hedge accounting, right? So the difference is we have to record in order to ensure accounting symmetry. Now, since we have to record gain or loss on the swap, the hedging item, now we're going to abandon the normal accounting for bonds, recognize the gain or loss on the bond as well in income statement, so they can cancel each other out. Okay, so I will stop here because I only have less than a minute left. I will stop here. So we will continue to do this example, but do try it. Do try your assignment first, okay?